The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The long road to return to normalcy. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S., and we're looking at tempered gains on the S&P 500. But if we finish in the green, that will be another record high for this index. We're going to see if we can hold on to this 0.1% rally here. You take a look at what's going on in the bond market. Another slight sell-off when it comes to the long end. 10-year Treasury yields higher by about 2 basis points. You swing down to the NASDAQ 100, a little bit more enthusiasm when you focus in on big tech here. But maybe some of the enthusiasm that we've seen in the stock market over the past week or so being tempered by what we are seeing in Brent right now, higher by nearly 4%. We're still below $100 per barrel, Romaine, but we're certainly getting closer.
Yeah, and the green on the screen there is significant because the sustained string of modest daily gains that we've seen in the S&P 500, 11 sessions in the past 12, really reflecting expectations that tensions in the Middle East are indeed de-escalating. But despite the round trip in equity prices back to pre-war levels, sentiment has not done a complete 180. You see that reflected in elevated Treasury yields, and you see that reflected in a softer dollar, with the market overall still betting on stable economic growth, but girding for the specter of inflation.
We've been telling clients that this is a good time to add some inflation protection to your portfolio. We've been recommending STIP, which is sort of the 0 to 5 year part of the curve. One of the benefits in having that is you're tied to headline inflation.
For now, the grind higher in equities is getting some support from technicals. That's evidenced by the institutional demand for call options extending further out into June. A technical backdrop that comes amid a relatively decent start to the earnings season after valuations were compressed over the last month or so. Keep an eye on Netflix. It reports after the bell tonight, and while the shares have surged 40% since mid-February when Netflix abandoned that Warner Brothers deal, the stock is still 20% below its record high from June, and its earning multiples, they're below their 5- and 10-year averages. Still, even with those valuation drops, the risk premium and volatility hedge is still a concern. For a given dollar of future earnings out there, investors are requiring almost a percentage point more in return than before the war. And that's a premium that actually started to creep up pre-Iran amid all the concern about the state of AI and the state of private capital.
Well, let's talk a little bit about private capital, because it's a good reminder that before we were talking about the war, which broke out at the start of March, there were a lot of concerns in this marketplace about the state of private credit and what is going on with software exposure here. So on the chart behind me, I have the Bank of America Private Credit Proxy Index. That's in white here. And then you have the KBW U.S. Banks Index. And you can see, again, the start of 2026 is when a lot of these concerns came to the forefront. And you can see, though, that the banks, at least in the U.S., have been resilient here when it comes to some of those private credit fears. We just got through the Big Six reporting this week, Romaine, and basically brushing aside those private credit concerns, saying they have about $100 billion worth of exposure altogether. But then you take a look at this white line, still mired lower here. And it's going to be interesting to see what happens when we hear from more of those alternative asset managers, which are due to report in the coming weeks.
And we've already started to see a modest rebound in some of the shares of those publicly traded BDCs. Here to provide some more insights about how he views that market is David Mihalick, co-head of global investments at Barings, kicking us off to the close. Great to see you here.
Thanks for having me.
So, we've heard from a lot of the big bank CEOs. The concern clearly not there, certainly not of contagion, certainly not of systemic risk. It does appear that a lot of the hand-wringing, if you will, that we've seen over the past few months seems to be about a few idiosyncratic issues, a few idiosyncratic loans out there.
Yeah, I'd say that's right. I think credit at the end of the day is driven by the economy. Certainly you can have short-term things when you have the outflows that we saw in the BDC space, and there are a lot of headlines around that, but medium and longer term performance in credit is really about how the economy's doing. And I think you mentioned the big six banks have reported. I think when you look through those earnings, their commentary around health of the consumer and things like that, I think overall the economy's in pretty good shape. And I think we've seen a little bit of spread widening in the private credit space, and that has really created opportunity for institutional investors. And I think you've heard a lot of the banks talking about seeing institutional clients taking advantage of that or looking to.
Was there any sort of disruption, though, in some of that demand? I mean, and not just because of the war over the past months, but some of the issues that even predated that?
I'd say it's certainly, when you have that kind of headline risk, I think it causes investors, whether they're retail, wealth, institutional investors, to ask more questions. And I think when we're back to...
Are they asking the right questions?
I think they generally are. I think when you're back to talking about things like software exposure, the health of the overall companies that are in the market, then you're back to me talking about the right things. Because over the long term, it is how the underlying companies perform. What is the risk of default and loss in the market? And that's ultimately what determines the return in the market. And so that, to me, if we're talking about that, we're talking about the right things, and that's the health of the market overall.
Well, you mentioned that, this episode, it's opened up opportunities for institutional investors. I want to talk a little bit about retail investors, because you think about a lot of the redemption requests we've been seeing and just the concerns overall. It seems like a lot of that was concentrated on that retail cohort. So, I mean, on the heels of what we've seen, we're through the first quarter set of redemption requests. Do you think that the demand from retail investors is going to be a little bit tempered going forward from here?
Yeah, I think an interesting thing to look at is all the headline numbers were about the gross outflows, and then offsetting that were actually other investors, putting money into these structures. And so while that headline number is important, I think overall you still have even retail and wealth investors putting money in. Net, because of everything that happened, there may be money going out. So we're through the first quarter, as you mentioned. I think the structures worked as they were designed. And if you think about the magnitude of those outflows, I think it was around $20 billion in aggregate in what most people would say is a $1.8 trillion market. And so, it's a relatively small part of the overall market. It's important. But given that outflow, you've seen spreads back up a little bit. You've seen, again, as I talked about, institutional investors looking at as a buying opportunity. And in terms of where the retail investor goes over the next couple of quarters, I think we'll all have to wait and see. But if anything, I think the headlines, hopefully have created, if it wasn't already there, that retail investors have more awareness about the asset class and how it works.
Yeah.
And so I think then when you come back to, I believe all investors are smart at the end of the day when they're allocating capital. And so they maybe have more awareness about the liquidity and the nature of how these structures work.
Yeah.
They'll also look at wider spreads, and I think potentially see it as a buying opportunity as well. It's too early to predict what will happen in the upcoming quarters, but I think all investors are looking for good risk-adjusted return at the end of the day, and so we could see that from retail as well.
Well, to your point, David, I mean, these vehicles, they were functioning as designed, functioning as sold. But I wonder, whether you think that there was some miscommunication. We've heard other shops, when it comes to the alternative asset landscape, say that, maybe there was some miscommunication about sort of the liquidity requirements, some of the profiles here of these vehicles as they were sold to retail investors. And I wonder, where you fall on that.
Yeah, I'm certainly, not in every room when every product is being pitched. I know certainly we try to do as good a job as we can on educating our investors. I mean, I think any reputable manager wants, an educated investor in their strategy. I think that is good for all of us, good for the health of the industry. Again, the asset class has a ton of merits. There's a ton of reason to own private credit. It's a first lien senior secured loan and a sponsor-backed deal. You get a very attractive risk premium. And part of what you give up for that is a little bit of liquidity. And so you want people to understand that when they enter the asset class. I think that is overall good for the asset class over the long term.
Before we let you go, I am curious about just the broadening of that asset class, too. I think when we talk a lot about this, we primarily focus on the direct lending side to a certain extent. Are you seeing a broader opportunities in, I guess, what we would now consider alts or private capital?
Absolutely. And I think that's something we've, in our business, seen the last couple of years. And I think these private credit headlines, which, as you say, are really more around corporate credit and direct lending, have really, when we said maybe investors have asked more questions, or maybe asking where can I get a similar return with maybe a little differentiated underlying risk profile. So in our business, real estate debt, infrastructure debt, things that maybe are not tied to the corporate credit cycle, very similar return profile, but you've got a building backing it. You've got a large infrastructure asset backing it. So maybe a little bit less risk because you've got that hard asset coverage. So we're certainly seeing more and more investor interest. And when we talk about private credit, it's not just middle market direct lending. It's opportunities in real estate, infra. It's not just below investment grade. It goes into the not just below investment grade. It goes into the investment grade space as well. Asset-backed finance is another area there's been a lot of headlines around, and we see a lot of interest in that as well.
David, great conversation. Great to have you here. Hope to have you back. David Mihalick, co-head of global investments over at Barings, and we're going to spend a lot of time today talking about the situation in the private capital space. And David made a good point about the state of the economy. We're going to take a deeper dive into the state of the economy. We're going to get the view from Bill Demchak, PNC Financial Services Chairman and CEO. He joins us next after the break, right here on The Close, right here on Bloomberg.
We're increasingly tracking the K-shaped U.S. economy with the Fed's Beige Book, indicating many households are facing financial strain while high income spending holds up. Big bank spending data also supporting the idea of a persistent divide. Let's keep the conversation going with the head of one of the largest banks in the United States. PNC Financial Services CEO Bill Demchak joins us now. Bill, great to have you with us. And I do want to start there because
it's good to be here.
Thank you. Well, there is the notion out there that that K-shaped economy, it's only being exacerbated by what we're seeing right now when it comes to higher energy costs and, persistent inflation here. I'm wondering what you're seeing when you survey the scene from your perch and whether or not, you think lower income consumers are being left out by some of the biggest banks.
Well, they're not being left out by the banks, but, even before the situation in the Middle East, we saw U.S. consumers at the lower end of the income spectrum getting squeezed by rent, by healthcare, by insurance costs, by food. Now you're adding gas to that mix, and even though, gas is 3 or 4% of a household's expenditures at that level, it starts to make a difference. At least for today, consumers continue to spend. So we haven't seen slowdown in discretionary spending from that lower income consumer. But eventually that kind of has to happen unless prices go, gas prices and other things decline or wages go up.
And it's interesting. I mean, how do you approach that from the perspective of being the CEO of PNC? Affordability is a problem right now. And I wonder, if you look to past cycles, whether there's anything instructive there.
I guess I would just lead off with the fact that, despite the change we've seen in the share of a consumer's wallet that now is going to staple goods in effect, the consumer is really healthy, right? Employment is strong. The consumer is still spending. We're not in this place where they're over-levered. Their balance sheets are good. Housing's strong. If they're, if they're a homeowner. So I don't know what to compare this to other than it's getting worse than it was yesterday. But it's not nearly to a place where, you don't see it in any delinquencies. It's not nearly to a place where either we or, the rest of the banking industry is particularly concerned about it.
So when you sort of look at your loan book, particularly when it comes to, mortgage companies, insurers, and obviously in the private equity space or private capital space, I should say here, are you picking up new business because of some of the concerns that we've seen out there over the last few months, or has it not changed?
Sorry, with respect to private credit?
Yeah, and private capital.
I mean, look at the margin spreads on speculative grade lending and opportunity sets there without taking quite as much risk have improved. But for all the headlines on private credit, the real headlines ought to be around what I'll just call speculative grade credit. So we see higher default rates that are creeping up in that space. We see more PIK loans kind of increasing at an increasing pace. The stuff you've seen on redemption from some of the retail-based funds isn't really the news. The news is, hey, is there weaker credit structures out there in the face of an economy that might be getting weaker? And if that's the case, then I think you'll see credit losses be greater than what some people are assuming right now. I don't know that I predict that, but we're in this world where it's hard to get much better than it's been.
All right, Bill, I do want to pivot to what's been going on in the real estate space, specifically with commercial real estate. We have seen, I guess, a relatively surprising strength there, given some of the issues out there. What are you seeing specifically with regards to where you're doing business over at PNC Financial?
So, in short form, a market has been created. So you think about office, right? We didn't know what recovery rates were going to be for buildings that lost their large tenants. And long story short, over the course of a couple of years, we've kind of established steadier values. By the way, there's a lot of loss content, and we and others have, charged off some loans, and you hear about people selling buildings at a big discount. But we all kind of know where the value is now, and that helps a lot, right? It kind of stops the scare factor, and now we can recapitalize and move on.
Is there a sense here, Bill, that sort of as we sort of start to recapitalize and move on, has the landscape of commercial real estate shifted both geographically, but also in terms of the types of things that are getting built and getting funded?
I guess at the margin, right? For a while, office is still really strong in hot markets, and things are actually still getting built. And you have buildings, in some cities that have massive lease increases and others that are empty. So it depends on the building, depends where it is. We had an overbuild in multifamily for a bunch of years. It's kind of worked its way through, and that's coming back. One of the things we talk about at PNC is this quarter was actually the first quarter in probably, I'm just going to guess here, but 2.5 years where our real estate balances actually went up as opposed to declining as loans ran off.
I do also want to talk about your M&A strategy from here, because you think about the First Bank acquisition. That deal closed in January, boosting your share when it comes to markets like Denver. Are you set for a while when you take a look at your portfolio, or could you consider, perhaps pursuing other deals to sort of fuel your expansion here?
Yeah, I don't know that we think about it that way. We don't have an M&A strategy. We have a strategy of growing share and retail clients across the country, which in our instance means that we have to, create more dense networks in certain places. Colorado was one of those, which is why First Bank made sense to us. But, there is a share grab going on in terms of retail clients where the largest banks are pulling traditional household DDA accounts out of smaller banks and, due to scale. We need to be a winner in that space. That means building lots of branches, being best in digital, activating your brand, best-in-class service, all the things you might do. And by the way, if you're really good at that, you might get an opportunity to then use M&A as part of the strategy to gather retail clients. But it's not, I just want to be really clear, but it's not like we sit around and say, who should we buy? That isn't the game at all. The game is we need retail clients because this market's consolidating, and anything we can do to cause that to happen faster, better, cheaper, we're going to do.
All right, point taken there. And before we let you go, I do just want to go back to the private credit conversation, because I'm taking a look at your earnings call, and you made clear that you have about $7 billion worth of exposure on your balance sheet, most of that being in CLOs. It doesn't seem like it's something that you're necessarily worried about, and I would just love to hear quickly, what gives you that confidence here?
In its simplest form, of our $7 billion, I think $6.5 billion plus or minus is in CLO form in the AAA tranche. To my knowledge, there's never actually been a loss in history on any of those AAA corporate credit CLOs. We're really comfortable with the outcomes. Maybe a soundbite helps. You could go through quadruple the defaults in the financial crisis and have twice the loss given default before it ever gets close to touching our tranche. So we feel pretty comfortable. We know the managers were good.
All right, Bill, really appreciate you taking time for us. Bill Demchak there, the CEO over at PNC Financial Services. We're going to talk a little bit more about the private capital space with John Rogers in just a bit. But when we come back, we want to check in on Netflix. Those shares have been on fire, up for a 7th straight day, part of an 8-week, 40% run into its earnings. Coming up after the bell tonight, when we come back after the break, we're going to tell you what investors want to hear most. This is The Close on Bloomberg. Shares of Netflix up for a 7th straight day as the streamer prepares to release results in less than an hour. Investors looking for clues about the company's future since walking away from the battle for Warner Brothers Discovery. Here to help break down what she has our eyes on is analyst over at Bloomberg Intelligence, Geetha Ranganathan, joins us right now. I mean, the numbers overall are pretty much in line, I think, with what we've seen in past quarters with regards to expectations. About 15% growth on the revenue side, decent growth on the EPS side. But you have a great note out, Geetha, that really caught my attention. And it's a focus on the ad business and the build out of that. And I know they don't break out specific numbers for that in detail, but you've got some pretty lofty expectations going forward. What are you expecting to hear?
Yeah, this, Romain, is really the new revenue stream that we think will be a growth lever for them for many years to come. So we do know that subscriber growth, it should go on as continued. We do see pricing power. We've seen some price increases. But advertising is really the new kid on the block as far as Netflix is concerned. And they, you know, it's coming off of a pretty small base. So let's be clear about that. It was only about $1.5 billion in revenue last year. It'll probably double to about $3 billion, but that'll still be only about 6 to 7% of Netflix's total revenue. But we think that as they kind of try to get better in terms of technology and they're able to increase their pricing power on the ad side of the business, this is a business that could potentially grow to about $10 billion by 2030. That represents something like a 45% CAGR and makes up basically a third of all the revenue growth that we're going to see. And not just that, it would pretty much represent about 15% of revenue in another 5 to 10 years' time. So really a big growth lever for Netflix going forward.
And less than a minute here, but talk to us a little bit, though, about the pricing power. We were talking to Michael Pachter over at Wedbush yesterday. He said consumers don't care, basically, if Netflix raises prices. But is there a certain limit? I mean, is there a threshold they could reach at some point?
So I think right now they still have plenty of pricing power. And I say that because, we've seen that their pricing, so they have raised prices about 29% over the past 4 years. But if you look at some of their competitors, like a Disney or like an Apple TV, those have raised prices by something like 70 to 80%. So Netflix is still pretty competitively priced. And for those who feel that maybe the price is a bit high for the no ads tier, they always have the option of going to the ad-based tier, which is priced really competitively. It is the cheapest version out there in the market right now.
All right, Geetha, really appreciate the preview. Those numbers coming after the bell today. That is Geetha Ranganathan of Bloomberg Intelligence. Now, coming up, we're going to be talking portfolio positioning with John Rogers. He is the founder, the chairman, and the co-CEO of Ariel Investments. Not a conversation you want to miss. Coming up next, this is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Katie Greifeld. We're looking at another record day for the S&P 500, Romain, but certainly a little less enthusiasm compared to what we saw yesterday.
Yeah, a little less enthusiasm, but this is a market that seems to be at least trying to price out some of that Iran war risk that was there. They seem to be looking towards, I think, what they see as a relatively stable economy going forward. And of course, we started earnings season. We're still very early in it, but so far, so good.
So far, so good. To your point, though, we've really only seen the big banks take the stage. We're going to get more into the heart of tech earnings. Really looking forward to Netflix after the bell. And, that is the engine of the stock market, for better or worse. So we'll just have to see. And
we talk a lot about public markets, but of course you can't ignore what's been going on in the private space. And Ariel Investments has been expanding there. A new platform, it's been out for a while, called Ariel Alternatives. And it is sort of really kind of at the vanguard now of what we started to see with the rubbing of shoulders between public and private markets. Joining us right now to talk a little bit more about this is the co-founder and CEO of Ariel Investments, John Rogers. John, great to have you here. Obviously, you really made a name for yourself as a value investor, a small and mid-cap investor in the public equity space. But I am curious about the push that Ariel has been making into alternatives, deeper into that private space, and how you see, if at all, any parallels between when you started this business 40 years ago.
Well, it's really exciting for us to get involved in the private markets. Our newest effort is Project Level. And it's really interesting. It's to support women's sports teams, women's sports leagues, and women's sports products, wherever you think there are opportunities. And it's been something that we often compare to what we've done in public equities. Finding smaller companies that are not well followed, not well researched, that have enormous upside. We think that's where women's sports has been. You know, it's been often neglected relative to men's sports. It's just started to take off in the last 2 or 3 years. So we think it's really in the early innings of a really productive time for women's sports-related businesses. That's Melody Hobson's vision, my business partner, who has really worked hard to bring this to fruition.
Yeah, and I mean, we should point out, I mean, we were lucky enough to speak with Jason, who helps to run that business back around the Super Bowl. And I remember when we were speaking with him, and just kind of this idea of why we're seeing so much investor interest in that, and for that matter, consumer interest or the consumption of it as well. What do you think changed over the last few years that allowed for that to become a much bigger investment opportunity relative to 10, 20 years ago?
I think some of the superstars are just shining so brightly. You look at the WNBA and you see folks like Caitlin Clark and Angel Reese and some of these folks that are just absolutely extraordinary players doing extraordinary things on the court. You know, there are some really big names in volleyball, big names in soccer. And I think as people just see how talented these women are, how hardworking they are, the effort they're putting into their greatness, I think it's just taken off. But you needed a few of those big names. Back, you know, a while ago, the NBA wasn't as successful. But when you had Michael Jordan and Magic Johnson and Larry Bird, it helped bring the league to a whole new level. And I think that's what's happening with these women today.
Yeah, and it's interesting. And, you know, I am always curious, how do you pick which sports that you're going to target here? Because you think about, you know, the big sports in the U.S. market, I have to imagine that there's maybe some bargain opportunities when you move past, you know, basketball, and this doesn't apply to women's sports, but football, for example.
Well, that's true, and there are different opportunities. We're not going to invest in everything or every league or every team or every product. We're going to look and make that analysis. Jason Wright has really led that effort and has great experience from his time as the head of the Commanders and his time as a professional football player. But, you know, we've been early, we think, with the women's volleyball league and with a Denver team in the women's soccer league. And as we're looking at all the other things happening with flag football, et cetera, there are lots of opportunities out there, as well as some that maybe won't be so successful. And I think we have the team in place to be able to make those types of judgments.
You know, and back when we had that conversation about Project Level back in the fall, you know, the notion that women's sports are sort of the small caps of the sports world came up. And I do want to talk just directly about small caps, because you think about all the cross currents in the global economy right now, and, you know, what this could all mean for Federal Reserve policy. We've seen small caps really see a lot of volatility. And I wonder, you know, John, where you currently stand on the outlook for some of those smaller stocks.
We still think the small stocks are really well positioned relative to large cap growth. The valuation measures are still significant. You know, again, large cap growth is so much more expensive than small cap value. Of course, they've had this enormous run of outperformance for large cap. But when that happens, everyone starts to fixate just on those large cap growth stocks and are neglecting a lot of misunderstood smaller companies that are not as well followed, where you can do the research and find some companies that are just truly these orphan stocks, I like to call them, where you can find some great value, some great bargains in the small cap sector.
I mean, I know you're bottom up, but how much of some of those bets are sort of reliant on economic conditions holding up? We've been talking about that a lot on this show over the last few weeks, particularly with the war in Iran and some concerns about whether there would be some material disruption to economic growth or further increase in inflation. How much do you have to keep an eye on that, John? And what do you actually make of what has actually transpired over the last few weeks?
Well, I think it's predictable that we would be finding a way to come to an end with this war. I think that President Trump and the Republican Party realize that they won't be able to be competitive in the midterms if they don't get this war over and get our economy back on track and get these oil prices lower. But at the same time, as we work in the small cap sector, we're looking at those kind of companies that we think can live in a volatile environment and still do well. Tomorrow we're going to visit Smucker's company, you know, jelly and jam and Uncrustables. We're going to go to see Scott's Miracle-Gro, you know, the fertilizer, things that, and so those are kind of businesses that are smaller, not as well followed, but also have great economic promise, great growth prospects, but nice and solid, steady kind of patient stocks that we like to invest in at Ariel.
Yeah, I actually have a box of the Uncrustables in my freezer right now. I have for years. You wouldn't necessarily...
Not the same box.
No, trust me. I cycle through them. But you wouldn't necessarily know that by taking a look at the shares of J.M. Smucker, because it's been a rough couple of years. And John, you think about your value investing experience. I wonder, what your sort of checklist looks like. How do you avoid value traps? And do you think that there are more or less of them in the market right now?
Well, I think what's helping with the value traps is that some companies, they're struggling to show growth in this economic climate and what's been going on in the economy. But I think what's going to be happening now, and as you know this, the regulatory environment has completely shifted. So companies that haven't been able to grow, now they're kind of bite-sized opportunities for private equity to come in and buy them, or to buy a subsidiary, or to have a company spin off companies. There's all kinds of things that investment bankers can help companies realize value in this environment, even if they haven't been able to grow at the traditional way that they have. That's why a favorite stock of ours is a company like Lazard, big-time investment bankers. And Carlyle, we were meeting with them yesterday, big time in private equity. We think those are kind of businesses that are going to help these smaller stocks show real value, sometimes through economic engineering.
So have we seen that shift? Because I think about the names that you have invested in over the years through public markets, and we think about sort of the explosion of private credit and the direct lending, which is effectively attacking that same kind of middle market, if you will, if I can use that phrase, that you have been a part of. So what does that sort of rubbing of shoulders of the public side of that and the private side of that, what does that end up being? Is one just going to morph into the other, or can they coexist?
I think they can definitely coexist. And sometimes you get these excesses that we sometimes see, and maybe too many people were getting into the private area and getting into private credit. Everyone thought that was a way to get rich quick and become a billionaire, and everyone's going to business school and jumping into those industries. But ultimately, at the end of the day, we think as some of those start to filter out and get weeded out in this more difficult climate for the private world, the big guys will be successful. We think the KKRs and the Carlyles, the Apollos, the others will be able to do really well, have the best people, have the cash to take advantage of the bargains that are out there, both in the public markets and the private markets.
All right, John, we're running out of time. We have to leave it there. Always appreciate you taking time for us. John Rogers, of course, hometown hero out there in Chicago, and more importantly, the co-founder and CEO of Ariel Investments. All right, when we come back, we are going to check in on some of the asset managers out there. The financial services companies have been under pressure all day. Schwab on pace for its worst day in weeks after earnings miss. That's our stock of the hour, and it's up next right here on Bloomberg.
Schwab shares sinking today. That was a tongue twister after slightly missing first quarter revenue estimates despite drawing in retail dollars in the face of geopolitical uncertainty. Another interesting line item from that report, a 39% year-over-year increase in daily average trades in the month of March. Let's discuss with Bloomberg TV markets correspondent Norah Mulinda. So shares down 7.5%. There were some things to quibble with here, but how do you explain the very, very negative reaction that we're seeing in shares today?
Well, we're clearly seeing a lot of attention on the top line story, really the street looking for growth, durability. As you pointed out, there was still some strength in other areas. We saw an EPS beat, but we did still see revenue for the first quarter slightly missing expectations. And so in this situation, it's almost like good just isn't good enough. Investors were looking for more. Of course, we know this is a story where a lot of people I've been speaking with, they're saying that a lot of people may have already seen the moves being priced in already here. Yeah. So you're seeing people taking a double look at this company and kind of digging into some of the more granularities, despite the fact that they did have this earnings per share beat.
And this is a company, there have been a lot of questions kind of about the future and the health of this company. One thing that came up on the conference call was the concerns about AI and whether that would sort of, supplant a lot of the products and services that Schwab itself is offering. Did he respond to that at all?
Yeah, of course, there was a lot of conversation on the earnings call about the CEO talking about this AI scare that everyone's been talking about in every industry. The CEO essentially saying that they're, quote unquote, well positioned still, but there is still this concern from broader Wall Street that some of these retail brokers may be caught in the crosshairs when we think about artificial intelligence really putting a dent on some of these individual industries.
Yeah.
And talk to us a little bit about what we heard just quickly here when it comes to prediction markets, because you think about these brokerages, obviously they have to have some sort of plan here.
Right, so that definitely did come up as well on the call. But the CEO was saying that he really wants to differentiate Schwab from its peers. He said, quote unquote, more gambling-oriented messaging that comes from their competitors. They're really trying to stay in line with what they feel is true to the heart of their business here.
Stay true to the heart. Norah, really appreciate your reporting as always. That is our Bloomberg TV markets correspondent, Norah Mulinda.
And just a reminder, Schwab shares.
Yeah, Schwab shares. I'm going to practice that in the mirror later. But coming up next, we're going to take you to the closing bells and the minute before those results are out of Netflix with John Belton. He is portfolio manager and managing director for growth portfolios over at Gabelli Funds. This is The Close on Bloomberg.
Medium and longer term performance in credit is really about how the economy's doing. And I think you mentioned the big 6 banks have reported. I think when you look through those earnings, their commentary around health of the consumer and things like that, I think overall the economy's in pretty good shape. And I think we've seen a little bit of spread widening in the private credit space. And that has really created opportunity for institutional investors.
David Mihalick over at Barings, basically expressing the sentiment that we've heard from a lot of folks out there here, that despite all of the market volatility, all the geopolitical uncertainty here, they're still relatively bullish, at least on the economy. And of course, that feeds into the assets.
Well, certainly we're seeing that in the S&P 500, the stock market at large over the past couple of days. The S&P 500 gaining a little bit of momentum into the close. That's going to be another record high unless something amazing happens in the next 9 minutes. And that's also reflected in the NASDAQ 100 ahead of those Netflix earnings. We're just about 10 minutes or so away from them.
All right, well, let's get right to it. Those shares kind of been oscillating. They had been in the green for a good portion of the day, now in the red. A lot of high expectations for what happens with this company, particularly after walking away from that Warner Brothers deal. John Belton joins us right now, portfolio manager and managing director for growth portfolios at Gabelli Funds. And John, I do want to start there. I want to go back to late February because we started to see this huge rally in the shares, up more than 40% since late February. And that was largely, it seemed like a sigh of relief by investors that they weren't going to pony up the multiple billions of dollars, and God knows how much time it would take to integrate that Warner Brothers Discovery business here. Where does that leave Netflix?
Well, thanks, Romain. Yeah, and it's a good way to frame the story and the stock right now. I mean, this was a stock that was really on a tear for most of last year. And then the second they started to talk about big M&A, the stock really started to trade off, and the market clearly didn't love the Warner Brothers idea. That, I think, that's at this point it's a bit of a moot point. No reason to debate it because they did walk away, and since then we're kind of back to what the story was before the deal, which is still untapped pricing power, a scaling advertising offering, a contained content budget, and so you had sort of a double-digit revenue grower, defensive business model, margin expansion, and good capital allocation. So I think that's kind of where we are today.
I know we don't want to sort of litigate too much the walk away from the deal, but do you think investors were concerned about that deal because of the cost of it, or because they didn't think that Warner Brothers assets, and more importantly, the integration needs that would need to take place, weren't necessarily worth the squeeze?
It's a good question. I think most long-term investors, myself included, were pretty excited about the prospects of that deal. I think I was thinking about it as sort of a one-time large content library acquisition, which could have good implications for content spend trajectory down the road. I think why it was so weak for the stock, shorter term, this was going to be a laborious approval process, and then I think there was going to be a big integration project once and if the deal ultimately closed. So I think at a high level, this was just a big distraction for the stock. I think it caused some faster investors to trade out, just given it was going to dominate the headlines for the foreseeable future. But long term, I do think there were good strategic merits to this deal.
And it's interesting. I mean, you mentioned that the story is now back to what it was before we had what you call a distraction. And the fundamentals heading into that, obviously, seems like they were pretty good. And especially you've seen that in the reaction since. So talk to us about what you will be looking for specifically when we get those earnings. What metrics will really be top of mind for you?
Well, the most important things tonight are going to be whether they change the full year 2026 revenue and operating margin guides. And, I think those guides were given, of course, while the Warner Brothers deal was still in the hopper. The revenue guide, it's unclear how much of this U.S. price increase was contemplated by that revenue guide. I do think that management has sent positive signals to shareholders after walking away from that Warner Brothers deal in the form of, an accelerated buyback. I do think they need to demonstrate to shareholders that they are still committed to a disciplined approach to capital allocation. So I'm looking for a raise to the full year operating margin guide. Revenue, I could see them tweaking the bottom end of the guide higher.
And where do you want to see those dollars spent? When you think about content in particular, obviously for a streamer, for Netflix, content, I have to imagine, is the name of the game.
Yeah. And there's no better place to spend those dollars than on the content budget. And you've seen them sort of re-accelerate content spend this year. In terms of content formats, I think they know one of the beauties of Netflix is they have such a great advantage in terms of their first party data that they've accumulated over the years, over the decades, across so many international markets. So I have full faith that the management team has a good process for evaluating content that's different than all of their competitors. But, of course, this stock is very much an earnings growth story. And so I think they have committed to growing revenues faster than they grow content spend. And I think they will continue to have to do that.
I do want to ask you a little bit about the ad business, which is starting to be built out. And I know we're not going to get any detailed numbers on it, but one of our analysts here at Bloomberg Intelligence did a great deep dive into her outlook. And this is a long-term outlook heading into 2028, 2029, and 2030. But she sees this as being kind of one of the real big levers for this company and, more importantly, for the stock. Do you see it?
Absolutely. I think it's still very early in this story. They more than doubled the revenue base last year. They've guided to another doubling this year. This is now a multi-billion-dollar annualized run rate business. And, more than just driving higher ad revenues, what this does is it allows Netflix to offer an introductory ad-supported price point that's much cheaper than their ad-free price points. And I think that makes this a more defensive business model moving forward. It both expands the TAM, it expands the addressable consumer. You now can pull in people that maybe wouldn't spend $15 a month but are happy to spend $7 a month on Netflix. But additionally, it gives an attractive trade down option for customers if the consumer spending environment does soften. So I think this is a transformative strategic move. It's been pretty successful over the couple of years that they've had it underway, and I think there's still plenty of growth, both for the ad revenues and the total revenues as a result of the launch of the ad tier ahead.
John, always appreciate your insights. Join us anytime. Be interesting to see what the backdrop is the next time as well. John Belton, portfolio manager, managing director for growth portfolios at Gabelli Funds. And of course, Katie, we await those earnings. Just a reminder, too, we are going to get some earnings out of Alcoa, the largest U.S. aluminum producer. But of course, all eyes are going to be on Netflix.
Yeah, absolutely. And you think about the trajectory of the stock over the past 6 months or so. Really, what an overhang was removed when they walked away from that deal.
Absolutely here. And right now, we have a broader market that is feeling themselves here on the day with the S&P 500 up 0.25%, extending its gains now for, I think, what is a 7th straight day or 8th straight day? Full breakdown starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell with the global simulcast. Carol Massar and Tim Senovic join us. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. As the stock market rallies, we should say the S&P up for the 11th time in the past 12 sessions. But more importantly, Carol Massar and Tim, this is really an afternoon where all eyes are going to be on Netflix, expecting to get those earnings right after the bell. Earnings growth of 15%, revenue growth of 15%, operating margins of about 32%. That is the expectation.
Yeah, you mentioned the S&P 500. I think the NASDAQ 100 now on track for its 12th straight gain. And I think you were checking that out, Tim. We haven't seen that in a long, long time.
Yeah, I think going back to 2017. I'm going back to Netflix, though, because this will also be a good view on price elasticity, Katie. They raised subscription prices in March, the standard plan without ads, by $2 to $20 a month. Did people stay? Did they downgrade to less expensive plans with ads?
Yeah.
Did we get any commentary around that? Because we're not getting subscriber figures anymore.
Well, it's interesting. I mean, at least the consensus of the guests on The Close thus far has been that Netflix has the pricing power, that they raise prices and folks are generally okay paying that. And of course, that all comes back to content and what they have on their slate there.
Yeah, and as to John Belton, who we were speaking with over at Gabelli, pointed out here, he really wants to see how those price increases, in effect, not only top line revenue, but more importantly, those operating margins. We should point out this is a stock that is sold off the day after earnings in each of the past 3 quarters. Expectation for today is an up or down implied one-day move of about 7%. Reading across the screen here on this Thursday afternoon, the Dow Jones Industrial Average up about 0.2%. The S&P up about 0.25%. I believe that is another record high there. Yes, it is, of course. The Nasdaq Composite up about 0.4%, and the Russell 2000 getting in on the action up about 0.2%.
All right, quick check on the big caps, folks. S&P 500, about 300 names to the upside, Katie, 202 to the downside, 1 unchanged.
Here's what the Circle says when it comes to the sector breakdown. 7 sectors finishing in the green: energy, real estate, tech, some of your big gainers today. In terms of what didn't perform on this day, healthcare, industrials, consumer discretionary, and financials. But overall, pretty decent breadth here.
All right, guys, I'm glued to my Bloomberg. In the meantime, quick check on an IPO today. Madison Air, ticker is MAIR. That went up more than 17% in today's session. On its first day of trading, company raised $2.23 billion, the biggest U.S. listing of an industrial firm in close to 3 decades, selling 82.7 million shares. That value.
I'm just going to interrupt you right now here. We're seeing Netflix shares take a lay down as the earnings cross the wire here, the headline number. And we're going to actually start with the second quarter forecast. That's the current quarter that we're in. The company guiding below analyst estimates, 78 cents a share on the EPS side. The street was looking for about 84 cents. It's also guiding lower on operating margin, 32.6%. The street estimate on average was for 34.4% there as well. For the first quarter, the quarter that just passed, the company did actually beat on those metrics. EPS at $1.23. That's about double what it was a year before. Free cash flow coming in at about $5.1 billion. The street was looking for about $2.7 billion. And on the revenue side, $12.25 billion of revenue for the current quarter. The street, Katie, was looking for $12.17. So a beat for the first quarter, but it looks like guiding below street estimates for the second quarter.
And that is certainly what's weighing on shares after hours right now, down about 7%. Of course, second quarter EPS, that forecast missing estimates. Getting another headline, too, that Netflix co-founder Reed Hastings will leave the board when term ends. So a little bit of an interesting tidbit there when it comes to the board. But again, as we were just discussing with John Belton, this is a growth stock. This is an earnings growth story. And at least for right now, you can see that disappointment coming through, Tim.
Maybe some investors in the past few months wondering how the company would grow without the addition of Warner Brothers Discovery. The company saying Warner Brothers would have been a nice accelerant for our strategy, but only at the right price, repeating a refrain that it has said many times in the past. We have multiple ways to achieve our goals, including producing, licensing, and partnering, and we're constantly seeking to allocate our resources to the most attractive opportunities to maximize the value we are delivering to our members. The landscape we're operating in, they say, is more dynamic than ever.
Can I just also point out, too, just another headline crossing the terminal. This is on the ad business. The company says it sees its 2026 advertising revenue on track to reach $3 billion. And we had Geetha Ranganathan over at Bloomberg Intelligence on the program earlier today. She's actually guiding, saying that this company can actually reach about $10 billion in ad revenue by 2030. So just in about 4 years, the company's saying they're going to get to $3 billion this year, Carol and Tim.
Yeah, just to rehash, if you're just joining us again, shares of Netflix are down almost 9% here in the aftermarket. Second quarter EPS, 78 cents a share. That's a big miss. It was estimated to be 84 cents a share. And again, we've talked about Reed Hastings to leave the board when the term ends. He is, of course, one of the co-founders. Still sees advertising, as Romaine said, 2026 ad revenue on track to reach $3 billion. But again, investors not loving what they got here.
Do you guys guys think? I want to go back to the Reed Hastings thing that Carol just mentioned.
Yeah, thank you.
Because I'm wondering if this is one of the reasons too. We're seeing some pressure in the after hours. This guy was, co-founder of the company. He's the one who pivoted. He brought DVDs by mail, pivoted with Quickster.
Yeah.
It didn't work, but everyone was like, it's not going to work. It worked. He invented this category.
Yeah.
Are they concerned that some of the innovation is leaving?
I don't know. He's kind of been on the sidelines for a while
Yeah,
now.
he has a ski mountain in Utah. He's doing philanthropy.
About this company, whose name comes up all the time. It's Ted Sarandos.
He's a content guy.
Maybe Greg Peters. And obviously having the presence of a founder on the board is important here. But I don't know. I feel like this company has already moved on and transitioned to it. And that's no disrespect to Reed Hastings and what he built. But I feel like they had already kind of moved on from that.
All I can say is shares of Netflix have jumped more than 40% since late February when the company announced it would not raise its offer for Warner Brothers. So investors certainly weighed in. So we'll see what they have to say on the call with investors and analysts to see if we get some more color about what's to come. It's all about engagement, like keeping people going back, because that's part of their ad model in a big way. All right, guys, again, we've seen Netflix down in the aftermarket. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine, of course, continuing there on The Close. We're coming back here on Bloomberg Business Week Daily on Bloomberg Radio and YouTube.
And our coverage of Netflix earnings continues here on Bloomberg Television. The shares in the after-hours trade down about 8% right now. The primary headlines here, revenue and EPS beat for the first quarter of the year. However, the company's guidance for the second quarter of the year coming in below what the street was looking for, both in terms of EPS, operating margins, as well as revenue, though the company does stand by its full-year revenue forecast. And, of course, the other big headline here is that co-founder Reed Hastings is going to step down from the board. This would effectively sever his formal ties with the company after stepping aside as CEO quite some time ago. Joining us right now to break down his reaction to what we just learned is David Joyce, senior analyst at Seaport Research Partners. All right, David, kind of unpack this. And again, in the context of this, the 7-8% drop we're seeing in the shares, obviously the big asterisk that this stock rallied about 40% over the past 8 weeks. What jumped out to you?
Right. So clearly the sell on the news is what's being exhibited right now, because the first quarter, while slightly ahead of their guidance, was below our estimates and street estimates. And the second quarter guide is also below our estimates and the street estimates, possibly because the U.S. Price increases are being instituted maybe a little bit later than people put in their models. But I think the thing that still gives us some comfort is that they kept the full year revenue and EBITDA or operating income estimates. So this could be an opportunity, I think, for investors who, after they took their profits, maybe to get back in a little bit lower, because it's going to be a while till there's another data point.
Is this, as you see it right now, David, a growth company, a growth stock?
Yes, it is. I mean, they're still going to be growing top line in the low double digits. They've exhibited margin expansion, even though they've been investing more in eventized sports rights, and there could be more on the horizon. But they're also finding new ways to engage with the consumer in place-based entertainment related to some of their brands, looking more into video gaming. So I think it is still a core holding in the sector, as well as one that has the growth characteristics, and that's where the market wants to focus. So I think that this is more of a timing issue, meaning it's a more of a back half weighted revenue and growth set of drivers. So I would not be scared off from this report.
And David, I want to talk about margins a little bit here, because when it comes to the second quarter forecast, they see operating margin at about 32.6%. That is below the estimate. They still see their full year operating margin at 31.5%, also slightly below estimates. When you're thinking about margins, how might that interact or influence what they're doing in sports?
So that is really a factor of timing. The back half of the year, especially the fourth quarter, is when you've got some of the special NFL games. They've had a couple games on Christmas Day, and now with the NFL seeking to redo its rights, they might carve out another 4 games, including Thanksgiving Eve, for example. So it's a combination of increasing sports rights costs and the need to be in that, as well as programming. They do place some of their more important important entertainment programming on in the fourth quarter, which tends to be more expensive, and therefore there's greater costs. So you're always going to have these ebbs and flows on the margins, but I think that largely explains it.
And I do want to talk a little bit about the price increases because we've been talking about Netflix's pricing power. You make a really interesting point in your notes that investors clearly like the price increases. If it does not tip the membership base into down tiering to ad tiers, for example, I have to imagine it's a fine line, even though it seems like right now, our people are happy to pay the cost increase. But where do you think that sort of threshold might be?
So I think the fact that they've got a pretty well-established ad tier, and that's where perhaps more than half of the gross additions, member additions, have been coming in. They've got the ad tech in place, and they've reiterated their plan to double, or expectation that they'll double their ad revenue to $3 billion this year. So I don't think that they really mind if people down tier. Yeah, there'll be a little pressure on the average revenue per member in the near term, but there's a lot of runway for them to add advertising on those ad tiers. So if people do tier down, but I don't think right now they're keeping the ad load fairly light, so it's not really an obtrusive experience if you're on the ad tier. But I also point to the fact that these membership increases, even if you're taking a premium tier or the standard tier and putting an extra member on there, you're still only paying $1 per day for this service. And in the times like we've had in the past month, where you get concerned about consumer discretionary spending, for example, and this becomes a utility. People are going to use this as a means of entertainment. We saw that the stock behave very well in last year's April tariff tantrum. So I think this has really got some really good attributes on terms of the growth side and the stability side.
Well, talk a little bit more about that, the idea of it becoming a utility, because obviously that still comes back to the idea of content. Obviously, we know the library they have already, obviously the new programming, and of course the push into live programming, live sports primarily. But one interesting thing I thought there was in the shareholder letter that they kind of bring up, and I know they don't give subscriber numbers, but they do say, and I'm just going to quote them directly, we're now entertaining an audience approaching 1 billion people, but it says we're still incredibly small. We only account for an estimated 5% of TV view share globally. So ideally, that would mean there is a big opportunity there to expand. But what gets them there? I mean, what gets them above 5% in any sort of meaningful way, David?
Well, I think there's still less video usage outside the U.S., and to the extent that they continue to add more content that is created in other countries around the globe that has some resonance and global appeal, I think that's something that could attract more viewers. They've been sourcing a lot from Spain and from South Korea and other countries. So I think that will continue to be part of their game plan on the content strategy, which should really help to reel more people in to spend more time with Netflix in their for their media usage.
Also, there's this idea of engagement, and we talked on the program last fall when Netflix opened these Netflix kind of experience thing. There was one out in Pennsylvania, and they talk a lot about this in the shareholder letter. How, of course, not only is Bridgerton a big success in terms of the streaming, but the idea that it spawned these in-person balls, as people kind of emulating the characters there. Obviously, the whole thing with Lego One Piece. Is there? I don't want to speculate too much, but do you think we could see a more meaningful, for lack of a better word, parks component? I guess if we're going to use a Disney comparison, I know they're not building theme parks, but something along the lines that keeps people tethered to the Netflix ecosystem, even when they're not at home or on their phone.
Yeah, I think that we'll see them testing some other ideas, possibly licensing the popular brand to a third party's park. But you also have a lot of location-based experiences that are standalone, IP-based facilities for consumers to enjoy that engagement. So I think that they'll, with the appropriate kind of intellectual property, they're not going to make this for every popular show or movie that they air, but for those that really resonate, Squid Games, Bridgerton, as you mentioned, we'll see what else they might come up with. I think that it is a way to help extend the brand, extend the engagement, and keep driving excitement and people to the Netflix site, and maybe extend seasons as well for some of these properties.
Kate, I just want to point out, they also say in there that those Bridgerton masquerade balls inspired 8 real-life marriage proposals.
No kidding. Yeah. That's pretty cute. I mean,
I don't know if that drives revenue, but that's engagement.
If your gal is really into Bridgerton,
it's literal engagement.
Yeah, what better place to propose than at the Bridgerton ball? Netflix shares, I will note, currently down about 8.8%, round that up to 9% after hours. So just plunging like a stone here, David. What do you think that, shareholders, traders, investors, yourself included, when it comes to the sell side community, want to hear from executives on the call when it kicks off later this hour?
I think we'll want to hear some more clarity on the content strategy. Some of these in new engagement initiatives, seeing what kind of experience they're having there. International growth, rollout of the advertising strategy. The U.S. is still the biggest market, but they're in 12 markets there. So I think the investors will want to see the fill-ins there to help understand that there's multiple elements driving to their guidance. And I think it would also help to understand just how the seasonality of the back half strength will get us from this slightly soft first half of the year. Again, I think largely that's going to come from advertising, and because they are still ramping that up, still bringing more advertisers in there. But that's industry wide. That's a mid-teens grower, and for Netflix to be assuming a double quantity of ad revenue, that means a lot more advertisers are coming to the Netflix platform because they're trying to recapture the people who cut the cord historically. So right. I think there are a number of growth elements, but the company needs to fill in some of those blanks in terms of how the back half is going to accelerate.
All right, David, really appreciate the breakdown. That is David Joyce. He is senior analyst over at Seaport Research Partners. And our next guest continues to view Netflix, quote, favorably at current levels, with the streamer remaining a top holding in the GK fund. His name is Ross Gerber. He is the co-founder and CEO of Gerber Kawasaki Wealth and Investment Management, joining us now. Ross, great to have you with us. You take a look at shares after hours, down nearly 9%. A lot of disappointment, clearly, when it comes to the guide. Just to set the scene here, I'd love to hear your reaction.
Well, nobody likes to guide high anymore because it doesn't make any economic sense for any CEO to be overly optimistic. So I think that they're playing the Apple playbook, which is keep expectations low. But I think these are great numbers. There's no parsing about it. I think what people wanted was even better. They didn't really up their guidance for the year or other things that I think people were hoping for. And so we see a little pullback in the stock. But Netflix is in a phenomenal position. They continue to just basically print money. They have a ton of free cash flow to reinvest into the business or to distribute to shareholders one way or another. So this is just a core holding for us, and I think they pulled a masterful gambit with the way they handled Paramount and Warner Brothers. So they're now the top player in the entertainment industry, and I think that'll be forever.
Well, you mentioned, what happened with Warner's, and we did see them boost their full-year free cash flow outlook. A lot of that has to do to that breakup fee that they got, $2.8 billion. I mean, as an investor in the stock, how would you like to see them sort of spend that breakup fee? Where would you like to see the money go to?
Well, after hours, they could just buy back stock. I think that the stock is actually relatively cheap compared to Netflix's historic valuation, and I think the market price hasn't really fully recovered from all of the merger stuff. And so as an investor, returning capital to shareholders, that's what they should do. If they can't invest it in the business, they return it to shareholders, and Netflix is pretty aggressive about doing that. So this is a great shareholder friendly company, and that's why we like it.
Yeah, and they point out, too, that cash flow, big cash flow number also accounts for the fact that they paused that buyback program. On the Warner Brothers side, I mean, they kind of flick at it very quickly here, basically just kind of reiterating what they had in that letter from February, where they basically said Warner Brothers would have been a great addition, and it would have accelerated their strategy, but in their words, at, quote, the right price. When you look at sort of the idea of what Warner Brothers could have brought to the table and what Netflix has going forward here, should we be looking at Netflix maybe having the potential to outpace Warner Brothers in terms of performance going forward? And I don't just mean in terms of the stock, but I'm talking about in terms of viewership, subscribers, et cetera.
Yeah, in fact, that's what's going to happen is, and why we're so bullish is what they actually did was they stuck, Paramount Skydance with a huge ball of debt that they'll never be able to pay off, on top of the fact that everybody in Hollywood hates the deal because they know it's going to be layoffs and less production because they've got to pay ridiculous interest on all this debt. And so what they did was, instead of having a bigger, stronger competitor, they forced that person to pay so much money that now it's a weaker company and has a lot of issues even just to complete this merger. And so they actually have less competition now. The way we look at Hollywood now is it's a two-horse game between Disney, Hulu, and Netflix, and that's basically it, because everything is either cut up or falling apart or not sure where it's going to end up or how it's going to be. So Netflix is in the driver's seat because Disney still hasn't fully articulated their streaming strategy in a way that would be competitive to Netflix. So what's happened now is they are the entertainment industry, or what we call, they're the cable company for the world now, and they could just grow forever.
Yeah, and I answer that question to kind of set up, too, this idea. We were having a debate with some of our colleagues about the pending departure of Reed Hastings, who's not going to stand for re-election to the board. I mean, this would effectively end at least his formal role in any sort of company management. Obviously, he gave up the CEO chair to Ted Sarandos and Greg Peters a while ago here. But when we talk about the innovation that he brought, particularly that big pivot to streaming, I mean, obviously, the mail order business was a huge gamble, but even that pivot to streaming, a lot of people had no idea what he was doing. And then when I look at Ted Sarandos and I look at how he has basically become a Hollywood mogul to a certain extent, Greg Peters a little bit there. What is the leadership of this company going forward? How is this business going to be run? I mean, what do you think their vision, Sarandos and Peters, assuming they are going to be the shepherds for this for the next few years, what does that look like to you?
Well, Ted is the king of Hollywood in a way that we haven't seen since 100 years ago, with just this kind of dominance, and also his relationship with so many in the creative community, despite changing the format in a way that a lot of people didn't like. People know if they want to get a project done, they should probably call Ted first. Reed really hasn't been that involved, and I think exiting the board probably has something to do with his political ambitions, which may or may not be true, and I'm hoping that he does actually spend his time trying to make this country a better place. And so exiting the board now makes a lot of sense for him, and also to protect Netflix if there's any blowback for taking any political, route. But he's talked about these kind of things in the past. So moving forward, though, Netflix is about Ted and Greg. It's really about Ted, and he's just in his prime, just dominating right now. So that's what it's all about. And what we see in the future is more of the same, which is how do we make sports a bigger part of what we're doing, but not paying ridiculous fees for sports rights? How do we continue to make the best content, whether it be shows? They're buying a lot of content actually from some of their competitors even. If you go on right now, Anaconda is one of the top movies on Netflix right now. They didn't make it, and so they're still buying content from people who realize they can monetize their content better on a competitive streamer versus their own, which is like crazy to me. So I think they've got a lot of levers, and they're doing well with video games right now. This is something a few people are starting to notice, but they really have now starting to attract younger people to their gaming platform, and that is a huge opportunity if Netflix can monetize their IP in gaming. So we like the direction of the business, and we're happy that they're focused on what they're doing and not trying to eat up a big merger that would ultimately kill them.
Right, absolutely. And I do want to talk a little bit about, you described this basically as a two-horse race. It's Disney, Hulu, and then it's Netflix. You called Ted Sarandos the king of Hollywood, which is quite a crown to carry. And I just wonder, what are the risks here? Because, the way that you're phrasing it, it sounds like this is Netflix's game to lose. So what would a misstep look like?
Well, the risk to Netflix, the internet goes out. I just don't know, what would hurt them now when this was the risk that they actually won the merger. See, if they would have bought Warner Brothers, Netflix would have been at great risk absorbing this dog. Warner Brothers has killed every company who has bought it, and it has been 5 now, and so it's going to kill Paramount, Skydance, just like it killed the other 4 or whatever. So I was really worried about that, and what we were betting on, that they were just trying to drive up the price and get out, and that's what ended up happening, and that's why we're more bullish than ever, because they're going to really be stuck with this. So it really is Netflix's game to lose right now. But when you think about losing in a generation that basically watches YouTube and Netflix,
right,
there is no losing for them. What they need to focus on is not getting lazy. Continuing to make good content, have high standards of what the expectation for that content is, and not getting lazy and just throwing money at all these projects because they're the top. And so as long as they continue to make high quality content, people will come. Just like there's some great Disney movies coming out this year. They've got 3 great movies on tap. And if you put out the stuff, people will watch it. And so as long as Netflix keeps making good content, they'll continue to print money forever, I think. So, you know, kids today, they watch YouTube and Netflix, and that's pretty much it.
Yeah, it's pretty wild. And in your view, Netflix just has to keep grinding here. But I do want to talk about the point you made that, you know, they buy a lot of content. It's not just Netflix content that's on Netflix.
That's right.
And they're also a buyer of Warner Brothers Discovery content as well.
Yes, it's all over their streamer right now, is Warner Brothers content.
Well, I'm wondering, I mean, then if you do see a situation hypothetically where, you know, Paramount, Warner Brothers Discovery, you know, that is sort of an albatross, and that's a company that's weighed down from here and not firing on all cylinders. I mean, I have to imagine at a certain extent that would be bad news from Netflix if there were less people, less firms producing quality content.
Yes, but, you know, I live here in LA, and there are so many people working on quality content that, you know, Netflix can find it on every corner here. You know what I mean? So it's really, I think, having less competition in content is actually bad for Hollywood as a whole, because I want to see all the studios survive and grow and prosper, because it's good to have lots of competition and great content. You get better content with more competition. So there's something to that. But I don't look at it that way. I think that business is sort of like a contact sport, and you got to play for your monopoly, and that's the way you win, is by having a monopoly. And the biggest, the Mag 7, the biggest, most successful companies in America are all monopolies or duopolies, and Netflix is now a monopoly, and that's where you want to be. And so any way you look at it, if I'm a producer and I'm working on a project, I'm calling Netflix no matter what, and that's just the way it is.
Ross, always a pleasure talking to you. Ross Gerber, CEO of Gerber Kawasaki Wealth and Investment Management, as we await, of course, the big conference call. It starts in about 15 minutes. It's not really a conference call because it's just one person asking questions. But there are going to be a lot of questions today. I mean, the shares are under pressure. Obviously, we had the big run up, 40% leading in today. So maybe just a bit of a give back. But a lot of questions about longer term, where this company goes, what margins look like. And of course, as Ross was kind of pointing out, what they do with a lot of that cash that they got because of the canceled Warner Brothers deal.
I did think it was funny to hear him say they should buy back shares.
Why not? Yeah.
That's what an investor would like to see. But
or maybe they could put it into another Anaconda movie. Have you seen the new Anaconda?
You know,
I haven't watched it yet.
Is it on your list? Is that something you're going to...
It is. Have you watched the Anaconda series?
No, I don't know what I really don't know.
Well, Anaconda, you remember Ice Cube way back in the day, and then they made like, 5 or 6 more of these, and somehow now they have one with Jack Black and Paul Rudd. I have no idea what exactly the point is.
Did that come out over Christmas?
I don't know, but every day is Christmas when you're watching a movie like that.
I don't know. We'll see. But I mean, content is king, obviously, for Netflix. I do think it's interesting to think about, could we enter into a world of content scarcity if you do have less competition? What does that mean long term for the industry?
What would get you? I mean, live programming. What would you want to see on Netflix? Like dressage or something?
No, I'd want to see
the clothes. Yes, absolutely. Here, we don't come cheap though. Yeah, keep that in mind, Ted. All right, when we come back, where our coverage of Netflix earnings continues, particularly coming off of all of that M&A mania. We're going to talk to Jeff Goldstein. He's the America's leader of tech, media, and telecom over at AlixPartners. Is there more consolidation coming? Stick around. We continue our coverage of Netflix's earnings and take a closer look at the M&A overhang That brought the shares some relief, of course, back in February, a 40% run into today's earnings. The stock's struggling, though, this afternoon as some people kind of question, at least for right now, the health of the operating margins as well as profitability going forward. But there is a bigger question here about Hollywood M&A, the entertainment landscape, if you will. Jeff Goldstein joins us right now over at AlixPartners. He heads America's tech, media, and telecom business over there. Great to have you, man.
Great to see you.
There's something interesting that you said prior to this, the idea that the streaming world has kind of moved from a land grab to a share shift. And we were talking with Ross Gerber just before you at Gerber Kawasaki, and he kind of alluded to this idea that we should probably see more consolidation in this space, not just because the companies are demanding it, but to a certain extent, in his view, the customer, the viewer. Yeah.
That's right. I expect that consolidation will be driven by a desire to drive more scale. The streamers right now are looking for an ever-increasing share of wallet from each customer, and that's becoming difficult on individual consumers, and they're finding that as their wallets come under pressure from macroeconomic trends, they're realizing that I've got some things that I'm not paying for. They're looking to cut back whenever they get a price increase notification. There's some that are very important to them. Netflix is an example that has much lower churn than a lot of the other streamers. And there's also quite a bit available on free services, whether it's creator content on YouTube or a free ad-supported television like Tubi or Pluto.
Yeah, and it was kind of interesting. We all used to joke a couple years ago during the pandemic. I had lost track of how many streaming subscriptions we had, but probably more than a year ago, we really started to pare them back to just some of the biggies like Netflix and HBO Max and a few others here. As you start to see that consolidation, though, do you think it would run into any issues? I know we're not in a really hyper-regulatory environment right now that would block M&A, but would there be any sort of impediment to getting those deals done?
It's all about how you define the market. When I was observing the original announcement of Netflix and Warner Brothers Discovery and trying to channel my professors back in business school who taught me about antitrust economics, I was thinking that if the market got defined broadly as all video consumed by consumers, Netflix should be in the clear because they're competing against companies like YouTube that have much more share than them, even when combined with a company like Warner Brothers Discovery.
Yeah, well, they said in their release today that they're only about 5% of the market, if you believe their metrics.
And it's very critical how they define the market. And Netflix executives went on a tour of the world. They were in Europe talking about the definition of the market. And what that tells me is they're still going to be opportunistic. I think that by trying to integrate with Warner Brothers Discovery, they found something in theatrical. They found something in television distribution. In a business that they had never been in, they understood it a little bit better now. And whether they do it organically, whether they do it by acquisition, I could envision them choosing over the next couple of years to enter one of those businesses in a much bigger way, just like on advertising, just like on live sports. They didn't do it right up until the moment they did.
And I do wonder, when it comes to M&A specifically in this industry, what do you think that sort of the prize asset that companies will be chasing here, for better or worse? I mean, is it content libraries? Is it what different companies are doing with technology and emerging technologies when you factor in AI to this conversation?
I think both of those are massive factors in the thinking of what people might want to consolidate. The opportunity to take library content that might be aged but might resonate with today's audiences and get a hit or get a little bit more likelihood that you have a hit with today's measurability technology. It allows companies to exploit IP much, much better. In addition, another one of the factors on why they would want to pursue consolidation, like you said, could also be that technological edge and trying to build scale.
Well, let's keep talking about that, because you think about AI, how this, interacts with the media and entertainment industry. I mean, you've written that basically AI and software disruption is this decade's cord cutting, which is certainly, a big statement to make. So walk us through some of the logic here and, what the parallels are.
That was a bit of a light bulb moment for me in the last couple of months as our software team released our software predictions. We were talking about how it would happen, and then it did, that company valuations that were at one time this high went down to this level. And those company valuations are doing that because of a perception that per-seat license model is under attack. If per-seat license models are under attack, companies need fewer seats on their software. What they're going to find is their churn goes up, and those churn numbers could be looking like a very similar curve to the cord-cutting curve, which itself was a very similar curve to newspaper subscriptions. The one difference I expect, this will happen much faster than cord-cutting did. There was time to observe, there was time to wait, but we're seeing with our software clients, there's a massive, massive shift that they're seeing brewing in the next 18 to 24 months.
But does that drive more consolidation, or more, more concentration in the market, or does that maybe potentially fragment it?
So we expect in the software market there's going to be more fragmentation before there's more consolidation. The reason why is a lot of private equity-owned businesses are in a difficult place on valuation, and you're not just going to be difficult to find a buy price and a sell price where both sides of the transaction agree. That'll make it difficult for consolidation over the next 1 to 2 years to be the only solution to the industry dynamic. Companies are going to have to work on either AI enabling their products or overhauling their service to the customer to infuse AI into it before the customers decide we're just going to build something ourselves in Claude Code.
Just one last quick question. I hate to put you on the spot here, but do you think there's any potential we could see M&A kind of involving sort of a content company with maybe a pure play software technology company?
Some would argue that that's what Paramount is already building, given the heavy involvement of the Ellisons with Oracle technology being a big guiding factor behind how they expect to drive synergies and growth within that business. I would expect that large software companies that might be coming under pressure will at least take a look at the businesses like this, but the idea that a software company would go to a media company looking for earnings and customer consistency, bit of a stretch.
All right, Jeff, really great to get some time with you. That is Jeff Goldstein. He is America's leader of tech, media, and telecom, partner and managing director over at AlixPartners. Meanwhile, let's take a look at Netflix shares in the after hours, continuing to sink here, down about 8% at the moment. We're minutes away from that call kicking off. Also put up shares of Roku as well, because initially they followed Netflix shares lower, and they still are lower in the after hours trade, but they had been down as much as 3%, still down about 1% right now. Let's also flip up with the board and get to some other earnings that we heard. Alcoa. Shares falling as adjusted EBITDA misses estimates here, down about 4.3%. And Knight Transportation down about 4.7% as well. This is The Close on Bloomberg. Roku shares following Netflix a little bit lower in the after-hours session on the heels of those Netflix earnings. And advertising revenue has been in focus for Netflix as it braces for that bigger push into live programming. Joining us live to unpack all the trends impacting that side of the business is MNTN CEO Mark Douglas. Mark, great to have you with us. So you write in your notes that it's all about advertising and live sports here. You take a look at what we learned at the top of the hour. How are you feeling on the progress that Netflix is making when it comes to that ad tier?
I think it's picking up. I mean, I think the way to think about Netflix overall, for a long time, everyone looked at subscriber numbers, and then they had the password sharing. It's just monetization. So no matter, they have many tools available to monetize. Advertising is by far the biggest one that's coming up. I continue to think it's just a huge backlog that they're tapping into, because they've announced in the past half of the new subscribers are getting the ad-supported tier, but they are not selling ads and serving ads at a rate that matches up to that number of subscribers, but they will eventually. So it's only going to keep growing, and they're definitely making progress in doing that.
Yeah, and we heard from the company that they still see 2026 advertising revenue on track to reach $3 billion. The estimate coming from our friends over at Bloomberg Intelligence, they see basically that reaching $10 billion by 2030. And Mark, you think about what we learned today. I mean, do you think that that sort of figure is realistic, $10 billion in 4 years or so?
I think that's laughably small, honestly. I mean, the demand is there. both from the consumers who continue to subscribe to Netflix and many of whom, half of the new ones who want the ad-supported tier. The demand is there from the advertisers. You have the SMB market coming into this picture, which Mountain led with performance TV. I honestly think that $10 billion is laughably small. It's going to be significantly bigger than that. And by the way, it is so profitable for them. So their EBITDA will grow much faster than their revenue in that business.
Well, I am curious too, like when we talk about the ad build out of the ad business. What's the balance, though, Mark? I know there's sort of this sense here that as they roll out these ads, customers aren't going to mind. The ones that want to pay for the higher tiers will pay for it. The ones that don't will trade down here. But is there any sort of risk, if you will, that they might go too far with the ads? I mean, because I can just tell you from personal experience, there are at least one other streaming service that I think went too far, certainly in our household.
Yeah. So, well, I think most services, tread lightly there in terms of, you're referring to ad load and finding the balance between, kind of consumers accepting the advertising and even in some cases liking it, and just kind of pushing on revenue. Netflix is, I think arguably the strongest player here. Disney's the only other company that really challenged them. Maybe the combination of Warner Brothers and Paramount over time. And so with that position, they don't have to push on the ad load in order to drive revenue. They can do it comfortably. But just given the number of subscribers and also the number of subscribers worldwide, the demand from every size business to access Netflix, and also things like AI creative, so the ads are more tailored to the consumer that's going to see them. Yeah. I think that it's not going to be a problem. People are willing to consider an ad a form of entertainment with one simple caveat: actually make it entertaining. That's all you have to do. Yeah. And so as more businesses do that, because the cost of creative is lower, the amount of customization you can do is easier. I don't think they're going to, cross in the realm of just like too much advertising. And I don't think they think that way at all.
Yeah. So Mark, I want to get your thoughts on the technology side of things, particularly given, the work that you've done at Mountain and kind of the melding of, I guess, content with the underpinnings of technology, which now has not only become the underpinnings, but might be front and center. And we were talking about this just a few minutes ago with Jeff Goldstein over at AlixPartners, this idea that it's really the technology that might actually drive, not just for Netflix, but a lot of these content companies going forward. And I am curious as to, how you rate what they've built there in terms of the technology platform, and how, if at all, that might become the bigger driver, both in terms of driving more viewers to the platform and also, of course, building out the ad platform.
Well, I think when you look at, it's an interesting question, because when you look at like Reed Hastings resigning from the board, which I think obviously is not a negative on Netflix, Reed Hastings created a tech company. And the technology was to stream, originally deliver DVDs, but then stream shows into the home. And Ted Sarandis, I think, has done a great job at leading the company, but he's leading a media company. And so I think what's really critical is that those technology roots not leave with Reed, that they remain in the company. Those roots are in Silicon Valley, where I believe is still global headquarters of Netflix. And so that's really, really important. They have to continue to be a tech company that provides technology for entertainment. If they do that successfully, then I think that's going to be a really, valuable, important part of the continued growth of Netflix.
Mark, always great insights here. We got to get you back and for a longer conversation here. I think as this company sort of makes its transition to the next level, we keep the conversation going. CEO Mark Douglas, CEO of Mountain, Mark Douglas there. We keep the conversation going right now with the head of a company called EDO, which actually tracks a lot of the metrics to help folks actually measure the effectiveness of TV ads. And that's coming at a time where Netflix is making that big push into more live programming. That includes Katie's favorite, WWE Raw, Monday nights, F1 Canadian Grand Prix, MLB, and then Mayweather and Pacquiao, a big boxing match there. Kevin Krim joins us right now. He's the president and CEO of EDO. Great to have you here. Let's talk about some of these. I mean, we've seen the experiment over the last couple of years. They also had, they talked about, 70 live programs that they had just in Q1 alone. A decent chunk of those were in the sports space. And I am curious as to how much some of these live sports programming might actually end up being more accretive to this company, particularly when it comes to not just subscriptions, but ad sales.
Yeah, thank you for having me in. The advertising world revolves around live sports, especially on TV. And it's because live sports has a unique ability to draw a large and engaged audience with both the programming and the advertising. So what you get is both volume as a lever and pricing of advertising, of monetization per minute per person at a higher level than anything else in the content library of any of these media companies. So live sports is really the engine that powers this whole ecosystem. And it also has a positive effect on subscribers as well. But in advertising, the way these media companies go to market is they are using live sports as the center of the packages that they're selling to advertisers. And in that case, it drives the rate up, the cost per thousand impressions that these media companies can charge. And live sports is at the absolute pinnacle of that pricing. And what EDO's data shows is it's worth every penny. It drives more engagement on a per person basis with the advertising than anything else on TV, bar none.
For the live sports. So the CPM that they get on the live side, though, does that transfer over to a certain extent to the rest, sort of if I watch Bridgerton or something else and I'm getting ads?
Packaged correctly.
Not that I've ever seen Bridgerton. I've kind of seen it.
It's okay if you have.
It's a good show.
Yeah, it's
a great show.
Yeah.
No shame.
4th season, right? So it powers a lot of the packaging and the overall rate that you can get from the premium end of advertising, which are these large Fortune 500 brands that are spending billions of dollars across the television landscape. The whole upfront is driven by live sports, and upfront is still a place where tens of billions of dollars transact in a matter of months for the rest of the year. And live sports, again, is the magnet that pulls those dollars in, and it lifts many of the boats across television. And what Netflix has done a really great job of is scaling up globally their infrastructure and their advertising. They're bringing a lot of subscribers into that tier. They also have this lever of price on advertising, and live sports draws it. Now, they don't have the scale in live sports that a lot of the other competitors do. There's a lot of competitors that have been doing this a long time. Amazon, who we haven't even talked about, has been doing Thursday Night Football on Prime Video now for they're going into their 4th season this fall.
Well, I mean, to that point, you bring up football, and you think about the NFL and just, how expensive it is. There's talk about, those 50% early increases in their rights fees, and the idea that that's something that Netflix might have to hoard cash to sort of pay up for. I mean, you take a look at the risk reward there. Would it be worth it, given that it is a very competitive, established market?
Netflix has some NFL already, right? But yes, you're in a hugely competitive space when you're talking about the rights to the NFL. You've got reports of YouTube looking at 5 games this coming season from the NFL, up from the 2 that it did last season. You've got, NBC Universal, Paramount, Fox, and Amazon all competing there. And I think it's a driver of audience. It's a driver of subscribers in the case of a service like Netflix or Prime Video and at Amazon. And you've got it as a driver of price because it's worth it. What we see from our data is that the NFL drives more engagement per ad, and because it's such a large audience, you'd have to buy, in some cases, hundreds of ads to replace a single ad on an NFL game in prime time. So the dollars there are rational, and frankly, there is some support to the idea that the NFL rights are underpriced.
And we don't have much time left, but I do want to bring in something that we were talking about with John Rogers, and that is women's sports. You write that they're a proven performance driver, and I think there's still a lot of people out there that would be surprised by that.
WNBA led the way in this, and Disney deserves a ton of credit for being an early supporter and backer. The unlock was the stardom that we saw from a pioneering group of the athletes coming out of college basketball and into the WNBA who became household names. That drives audience. Audience drives the media dollars, and then you get the wheel turning in a way that supports other leagues in women's sports. And so, we called it the Caitlin Clark effect, that Caitlin Clark on television, whenever she was in a game in college and then heading into the WNBA, you saw larger audiences, more engagement with the ads, and when Caitlin Clark was in an ad, you saw even better performance for the advertisers that were backing her as sponsors. That kind of wheel starts to really turn.
So we just need more Caitlin Clarks. Kevin?
Well, don't, Katie.
Yeah.
In 1 month, Ronda Rousey and Gina Carano. You like fighting, right?
I have watched her fight. It's pretty scary. Anyway, Kevin, it's great to spend some time with you. That is Kevin Krim. He is president and CEO over at EDO.
All right, we are going to set you up for what to watch when we come back over the next 24 hours. We should point out that Netflix conference call is underway. The co-CEO Greg Peters talking about, quote, plenty of room to grow in the market. Stick with us. This is The Close on Bloomberg. All right, welcome back to The Close. We should point out that Netflix conference call is underway, Katie, and some interesting comments. Co-CEO Ted Sarandos saying, we met a lot of great people at Warner Brothers. I don't know what that means, but he also says that the Warner bidding built our M&A muscle. Is that foreshadowing to something?
Really interesting to see if they flex those muscles in the months ahead, but certainly also saying co-CEO Greg Peters saying that there's plenty of room to grow in the market, in their addressable market as well, but not necessarily lifting shares yet after hours. Yeah, that is the long-term story. Of course, the earnings in the first quarter a beat, the second quarter forecast a miss, but a lot of folks looking past that. We'll be back tomorrow right here on The Close.